part 4 of the web series, and we're talking about interest rates.
Right, so this is the last part of the webinar series before we get into the main kind of like investing tips, techniques, types and all that. But it's an important one to know. So do you know what interest rates are?
Roughly?
Yeah, like what is it roughly then?
It's when you there's an interest rate to like a bank account or something,
Yeah.
and you get more money because of that.
Yeah, kind of. Yeah, so it's how much you are owed or have to pay back on a loan. So if you take a loan out from the bank, it's how much you would have to pay back to the bank on top of the loan that they gave you, or it's interest that accumulates on your savings account in a sense.
Okay, yeah.
So we'll just go through kind of a little idea of it. So if we have interest rates that are 1% and you borrow £100, so when you have to pay back after a year, let's say, your loan, you'll be paying back 100. Yeah. And then if you were to say do 5%, it'd be 105, 10%, 110. And that's the simple and basic premise of interest rates. There's nothing major to say about that. But why it's important to know about, especially just in the financial kind of standpoint. Well, interest rates are, so we're going to go back again to like the word recession. So we'll definitely do a video on it. Second time I said it. But so before the last financial crash, before it all went downhill, so it happens on average, a financial crash every decade. So the last one was 2008. Just before 2008, probably around 2006-07, the interest rates were around 6%. I think just lower than 6%. But since that kind of financial crash, it's been at 0.5%. So there's a big difference between 6% and 0.5%. So there was even dipped a bit lower for like a year or two, like 2016 to the start of 2018 to 0.25%. And now it's back at 0.5%. So it's not that high really at all. But so what do these things mean? So when the interest rate is increased, that usually means the economy is doing very well. And this kind of is the kind of government trying to reduce borrowing basically, or they're trying to get people to be discouraged from borrowing from the banks. Because if there's a higher interest rate, let's say right now it's 0.5, but if they increase it back to let's say 6%, why would people want to be borrowing? Oh God, intermission. Who calls this late on a Sunday?
They picked up though.
Who the hell would call? What time is it? Jesus, it's 10 on a Sunday. Who called? Alright, back to it. Okay, so right now 0.5% is interest rate, but if we were to increase it to 6%, the idea is that people are discouraged from taking out loans from the bank or borrowing money in general, because who would want to pay a 6% return when right now we're paying a 0.5% return. But then the same goes vice versa. So if we were to then again drop the 6% down to 0.5%, that's because the economy isn't doing as great, and they're trying to encourage borrowing and loans so that people can have money to then start spending and bring the economy back up. So it's a cycle, and that's why on average there is every 10 years we have a recession. And it's a cycle of it. We're doing great, the economy's great, but no one wants to. Yeah, no one's borrowing money. They're being discouraged from borrowing money, but that also means they're spending less. So the economy drops, interest rates drop as well, and then that means you're borrowing more, you're spending more, and then you're back up again where the economy is good, and full circle. And that's all you have to know about interest rates, really. Just the basics of it there. It's the interest you can accumulate on your account, or the interest you have to pay back to a bank or a lender. that was just a quick one basically on interest rates. So yeah, I think we'll finish there. If you have any comments, please always leave them in the comment section below. And thank you.